Hi, good afternoon, everyone. Is that working? Okay. If I can just have everyone's attention, please. We're going to get started in just a couple minutes. I just want to go over a couple Cpe requirements, if that applies to you. Just make sure to sign in and out at the beginning and then when you leave. And then fill out the evaluation, which you'll find in the middle of the tables there. Here are the Cpe learning objectives, which I won't read through. And then our presenters today are Mark, Una, and Sergio. And with that, we'll hand it over to Mark.
Very good. Thank you for all coming. Welcome. See a lot of familiar faces. Always a pleasure. Quite a hot topic these days, I guess. We've got overflow. Hopefully you can find a place to sit comfortably. As Congress was kind of rushing through this bill, which started in the fall, we were hoping for, and you heard over the last few years, tax simplification was a focus. Well, we didn't get that. There are some simple aspects of the bill. Standard deductions increase, so that's going to take some people out of the itemized deductions. But for the most part, that's not our clients and probably not many of you here. The complexity about the new bill is quite daunting. One of the news feeds I read that was, it might have been even in the Wall Street Journal, the headline was, if you have any questions about the new bill, don't ask your tax attorney because they're still trying to figure it out. So we're still in that. One of our clients called us, I think, on December 26th and wanted to meet on January 3rd. They were coming back to town. What can I do? And I said, could you give me till the 10th? Because we wanted a chance to absorb it. So we're going to try to download some of that information now to you. The complexity is expected to produce some technical correction acts, 1 or 2, maybe 3, which is typical, and this is done to correct some language issues, clarify language, and to produce guidance so that people can act and plan accordingly, and we can do the tax compliance along with it. In addition, regulations will be written over a long period of time, which is typical whenever any new tax bill comes out. But with the IRS budget constraints and investing their money, maybe rightfully, into data security, which is very important, we're not sure how fast these regulations are going to come to fruition. So we're kind of in a place where we'll take our positions, plan our strategies, and upon examination, it kind of depends where the final regulations come down, or you have to make your best case if they have not been written. So that's kind of the background. Most of the provisions I'll be talking about on the individual side, because I'm going to focus on that. My role in the firm in Los Angeles is I'm in charge of the Family Wealth Group. We primarily work in non-active businesses with families, their generational issues. So I'm not in the active businesses, and we've got Una and Sergio to talk about those and real estate as well. Much of the provisions I'll be talking about expire after 2025, and everything resets back to 12/31/2017. I will point out a couple of areas where there are permanent differences, but if I'm not talking about any dates, that's because all this resets. So we'll start with, are we on the first one? Are we on the first slide? Let's talk about tax brackets. That's pretty simple. So they've reduced the brackets across the board. 0, 10, 12, you can see them there. Some slight reductions. The highest bracket has dropped from 39.6 to 37%. Most importantly, it's where those brackets fall. So for example, the highest bracket at 39.6 was imposed after income of $471,000 in 2017. 2018, the new bracket, 37%, kicks in at $600,000. So not only is the bracket down, you're going to be paying lower amounts up to the $600,000. Standard deduction. So they've been increased, and you saw this a lot in the press. A lot of focus on it. Oh, they're increasing the standard deduction for an individual from $6,350 to $12,000, and for a joint from whatever it was, $11,000 to $24,000. Well, you also lose your personal exemption, which is $4,050 a person. So for a family of 4, for example, they could be worse off because their standard deduction was 12 plus 4 times 4,000, you're at 28,000. So now they're down to 24,000. So they're not in a better position. Give you an example. I'm going to drop in a couple examples as we go. I did my mother-in-law's tax return yesterday, and it's always my first one. And it's a W-2 and Social Security because she works a little bit. So she has a standard deduction, and her standard deduction went up $1,600 because she's over 65, and you get a little bump for that as well. So her tax went down $150, which was 24%. So most of her change is coming from where the brackets fall. So you've got a lot of retired people. This will be good for them. Similarly, I'm going to come to the next one, though. Okay, let's talk about the impact of charity that some people have been talking about. I think most of the clients that we're working with, and many of you in the room, you have a mortgage, and we'll talk about mortgages specifically later. You have a mortgage, you'll have property taxes or state income taxes now capped at $10,000, and you're already giving charity to some extent. You're over the $24,000 anyway. So you're still getting a benefit from your charitable contribution. Now, I could be a cynic and say, oh, people are going to stop giving because they're just doing it for the tax savings. In effect, for those people who are using the standard deduction, it may now cost them more to do so. If they want to give $100, and before they were getting $30 off on their taxes, it costs them $70. Well, now it's going to really cost them $100. So you might see some of the smaller contributions dry out. I'm the treasurer of a local charity, and our fundraising is primarily individuals, some private foundations, but our constituents, if you will, they support us because it's from their heart, and they believe in what we do, and they've been personally touched, or they have a connection in some way. So we believe that they'll continue to give. Excuse me. Okay, now here's the elephant in the room. State income taxes, along with real estate taxes, are now capped at $10,000. So that's pretty huge. The impact depends on whether someone was in alternative minimum tax or they weren't. So if you were in alternative minimum tax previously, you weren't getting the benefit of those deductions anyway. So in effect, what they've done by eliminating some of these deductions or limiting them, they've made the alternative minimum tax permanent, because now they're not deductible at all, and before you weren't getting the benefit. Different tax rate, but I'll run through a little example of that later. California, we don't know whether they'll conform or not to this rule, and that really only impacts real estate taxes. But I see a few in the room, I know their real estate taxes are considerably larger than $10,000. So if California does not conform to this aspect, you'll still get the benefit for California purposes. And if they were sticking true to their publicity, that they were lobbying hard to maintain that real estate and state income tax deduction, they would be hypocritical to say, okay, we're going to go along with it and limit the real estate taxes. So we're hopeful they'll stick to that. Speaking of alternative minimum tax, for the most part, it won't be as applicable for some people because the add backs are eliminated. So state income taxes, real estate taxes, limited to $10,000, so you don't have to add those back anymore. The miscellaneous itemized deductions that you were getting over 2% of your income, those were deductible before for regular tax. Now they're just out altogether. So that said, they have increased the exemption. So now a joint filer formerly had an $85,000 roughly exemption. Now it's $110,000. roughly. So we'll see less people subject to alternative minimum tax. Health insurance. They've eliminated the mandate for individuals beginning in 2019, I believe, to acquire health insurance. They have still intact as the fundraising, if you will, the Affordable Care Act, net investment income tax, and additional Medicare tax on earned income. So that's still in place. What we think might happen as a result of younger people who tend to, I'm healthy, I don't need insurance, I'm not going to have the government tell me I have to have it. If they drop out of the pools, the rates are going to go up because the insurance companies use the healthy who don't use the services to kind of balance their exposure so they can keep their premiums so they're more affordable. But if you drop those healthy people out who aren't contributing, then they're going to be inclined to increase the premiums because their costs will go up. Medical expenses as to taxes. So they've now reduced the adjusted gross income amount to 7.5% is the hurdle. You may know that you can't deduct your medical over that 7.5%. This is nothing for seniors over 65, as that was your hurdle to begin with. Although they added it back to 10% for alternative minimum tax, and those of us under 65 had to meet a 10% hurdle. So this is not a big deal. It will come into play assisted care, which is a big expense for many of our clients. That expense does exceed those AGI limits, so that'll benefit some people certainly. I'm going to just break from the slide for a moment. I did another 2017 to 2018 comparison on a client who's a professional, sole proprietor, and his taxable income is about $1 million and his adjusted gross income was about $1.3 million. He was not in alternative minimum tax, which means he was getting the benefit of his state income taxes, his real estate taxes, his miscellaneous itemized deductions to the extent they exceeded 2%. And when I flipped that into 2018 and looked at the results, so his $150,000 state and real estate tax deduction went to 10. He lost $33,000 of miscellaneous itemized deductions. One bonus he did get is they've eliminated the limitation on itemized deductions, so he got $28,000 back. He ended up paying $5,000 more, or he would, than last year. There's no way nobody can eyeball that. Nobody can just guess. There's so many different attributes going on that affect these changes, you have to run the numbers. I was surprised, actually. I thought it would go up more. But the reduction in rate and where the rate starts at the highest marginal helped defer that problem of the deductions. Yes, Elaine?
I had a quick question on the medical expense.
Yes.
Is that just for 2018 and 19, and then you don't get it?
Yes, so that adjustment, their question. So on the medical expense, there is a different date for that. The 7.5% hurdle goes back to 10% after 2019. So that's a short-term adjustment. Okay. I did another, for example, and this, think of it as Iowa. You have a $75,000 W-2 person who doesn't own a home, got 2 kids. When I ran their numbers, increasing their standard deduction but losing their exemptions, their taxable income actually went up by $5,000, but their tax went down $600 or 7.6%. So you expect a different result, but that's what happened. So I guess the moral is, as we're doing your work, if you're a client, or if you're working with your other accountant, or if you want to come on by, we're going to be looking at these because I think it's interesting to know. If you just assume all things created equal, what would next year look like? So we'll be doing that with our clients. I think we're to the next slide. All right. Charity. This isn't much either. it changes to 60% of adjusted gross income instead of 50%. So that's your limitation on a year basis. There's still a carryover. The 30% limitations and 20% limitations for those of you that give appreciated property to your private foundations, same limitation, no change there. The estate, let's talk about estate tax for a minute. So the exemptions are now doubled. Married couple went from 11 million to 22 million approximately. Now keep in mind that sunsets in 2025, it's going to flip back. So you should still be doing the planning you've always been doing, and you should take advantage of this new bucket you can fill up with $11 million. Coupled with IRS has backed off on trying to defeat discounts for limited partnership interests. That's off the table. So now we can go, people were concerned about that, now we can go back to doing what we've been doing. Yeah, in the proper manner, of course. So you do want to consider filling up those buckets with appreciated property, but you have to consider the depreciation aspect, making sure you take advantage of any step-ups. Step-up in basis still available. You know, you want to do the estate planning because you want to make sure you have guardianship set up for minor children if you're younger. You want to make sure you protect asset protection, future bad spouse, the usual stuff you want to do. Keep it out of probate. No reason, oh, I'm not going to have estate tax to pay. You still need to do some planning. Going to advance the slide.
Next slide.
Yeah, I think so.
Mortgage interest.
Mortgage interest. Okay. Mortgage interest for new mortgages after December 17th, I think is the date. If you're contracted, the limit is now $750,000 where you can deduct your interest without limitation. $375,000 for married filing separate. If you have your old limitation of $1 million, you can still use that. If you refinance that debt down the line, you still get to use, so let's say you've paid down your $1 million mortgage to $800,000, you refinance $1 million, take a couple hundred out, you can still use your $800,000 mortgage balance for your interest deduction. The other $200 not allowable. Home equity line of credit, mortgage interest is now out altogether, even if you used it to improve your house. So they've just decided that that's not something they're going to go with. That's about everything in that area. The next section will kick us off into something we're all going to talk about, and that's a pass-through deduction. That's the term thrown out in the press, and is really the most exciting part. I can't believe I said exciting. But we'll cover a lot of ground here. But I'm gonna tell you something you may or may not know, but it's going to eliminate a lot of people from participating. And that's as if you're a professional. If you provide services in healthcare, accounting, law, consulting, financial, performing arts, anything that might be construed to your personal service, your reputation, your personal skill is not subject to this qualified business interest deduction. That's the 20% deduction you've all been reading about. There are a lot of limitations related to this. There are income limitations. For example, if you do happen to be an accountant that makes, as a married couple, your taxable income is under $315,000, you do qualify. So there are some de minimis rules that you can qualify for in these fields. One thing they have carved out is engineers and architects. They can participate. And the reason why, the intent of this deduction is to generate domestic production of tangible property. That's my take on it. They want manufacturers, they want investment, they want employment. So I think they figure architects and engineers are going to be prominent in the real estate development, which obviously generates a lot of employment. We'll come back to you. Thank you. Now, they don't necessarily have the funds, so I'm not quite sure how they're not doing the investment. They're just a professional contributing to the process, but they must have had a really good lobby because they're in on that deduction. I'm probably going to head towards my colleagues here, Una, so she can get more into the details on this qualified business interest deduction. Just make sure if there wasn't any key things I wanted to say. Oh, yes. Thanks, that is on my list. Alimony, after 2018, for new agreements or modifications to existing stipulations are out. No more deduction, no income to the recipient. So we expect the family law industry, they're going to have to adjust the dismaster calculations to pull out the tax benefit to the payor. There were a couple other things. Thank you. 529 plans. Very good way to pass money, if you will, to grandchildren or children. In the past, the qualifying education expenses had to be for basically college and any technical schools past high school. You're now allowed to do $10,000 to primary and secondary school per year. So that's a nice little extra that they've put in. That is per account, yes, per child.
Mark, there's another question.
Question?
Yeah. Well, child support is never deductible. So the factors that go into those calculations are basically income and cash flow. So I suppose if they pull out the alimony deduction, there may be more money left over for child support, if that's how it works, in fact. So it's only with respect to the deduction for alimony and having the recipient pick up the income. One client asked me, should my employees now be independent contractors? Because he hadn't read anything about it. And the first answer is employment law trumps tax law. So an employee is an employee is an employee. So you have to get past that first. The other answer is no, because the employees are probably providing services they wouldn't qualify for the deduction to begin with. Now, maybe they should be S corporations. And with that, I'm going to hand it over to Una.
Hello. The way I want to spend my 20 minutes here, let me do this here. I'm going to touch on big things very briefly, and I'm going to spend most of my time on 4 things that are most important to you, because this is probably where you're going to see the most increase in tax or the most decrease in tax. And I also want to mention a couple of things just because I looked at the attendee list, so I know it's going to be important to some of those folks. Quick things that you guys probably interested in, but it doesn't apply to you that much. Permanent reduction in corporate tax rate, 21%. A lot of you are now thinking, hey, should I be converting to C corporation? Generally speaking, probably not, unless you're a startup that is thinking of selling to Apple or a company like that, or you're starting a new multinational corporation. For the rest of us, probably not. There may be some very limited circumstances where you may want to do this, but it's for 99% of our clients, it is probably not a good idea. The other big thing, which that changes the landscape for probably every single multinational in this country. And it is, we are going from worldwide system of taxation internationally to territorial system of taxation. What do I mean by that? I'm gonna very much simplify this, but basically if you are US corporation and you want to produce something in France, unless you jump through hoops, whatever income you generate in France is taxed in United States, generally speaking. Yes?
You skipped over the subchapter as corporation. Could you explain in what circumstances it is
I didn't get to subchapter S. I was talking about C's. I'll get there. Now, basically what's going to happen, the same multinational earns income in France, the French tax that income, the US multinational received the dividend received deduction when money come over. So, or not come over. Actually, it doesn't matter. You don't have to repatriate. There is one time, obviously, how do you go from worldwide system to territorial system? We all read newspapers. We all know that, this big bad multinationals park millions and billions of dollars overseas. So the way to kind of cut the cord, so to speak, what happens is there's going to be one-time repatriation tax. And it's like always, an incredibly complex calculation. You need to look at your earnings and profits. You need to look at your income under the laws of the country in which you earned them, then convert it into GAAP, then convert it into what's called an E&P, earnings and profits. And you need to do this from 1986. Seriously, I'm not kidding. So, and depending what kind of assets you have, there's going to be either 8% tax or 15% tax. And it doesn't matter whether you bring money back or not. It's just one-time repatriation tax, and that's how they're going to go. That's how they're going to go from worldwide to territorial. So that's kind of a tidbit, because I don't think a lot of you here are. It's interesting to know, but it's not something that you necessarily you necessarily need to know for yourself. So let's go back domestically. So let me go back to this 20% qualified income deduction, qualified business income deduction. A few thresholds. If the taxpayer makes a joint tax return, if the taxable income is less than $315,000, it doesn't matter who you are. It doesn't matter the limitations don't exist. Whether you're a doctor or an accountant or a lawyer, you get that 20% on the flow-through income. And the way they define flow-through income, partnerships as corporations or sole proprietorship. So if you're a lawyer and it's a Schedule C for you and it's under $315,000, go get more clients. But other than that, you get the full 20% deduction. Between $315,000 and $415,000, that limit starts to phase out. Once you hit $415,000, this is where this law becomes really complicated, because now all of a sudden, on the entity-by-entity basis. Oh, by the way, let me take the poll. How many of the people in this room get more than 5K1s on their tax returns? How many get more than 10? Over 100? So guys, that limitation applies on entity-by-entity basis. So for each of your K1, we need to calculate this. And the limitation is 20% of income that qualifies for this deduction. So all your professionals are out, your accountants, your lawyers, your consultants, the artists, probably designers, anybody. And the way it's phrased in the law, it's anybody who generate income by their skill and reputation. What?
Eliminates engineers, no.
No, engineers are specifically, I guess engineers don't have skill or reputation, right? No, actually, engineers and architects are specifically excluded. But we're not quite sure what that means that by skill and reputation. I would argue that I go to a tailor to get my clothes altered because of that person's skill and reputation. Well, clearly, this law is not that's not the intent of the law to catch these people, but that's how it's worded. So that's back to Mark's point. We don't know exactly what that means yet because a lot of it is very, very vague. So anyway, so let's assume that you have you are manufacturing widgets, for example. You know, clearly manufacturing, you're subject to, you can qualify for this 20%. And your taxable income is more than $415,000 married filing jointly. So you look at your K-1 that you receive from this entity, or maybe it's a Schedule C. You look at your allocable portion of that income, and you take 20% of that. And then you compare this to 50% of the wages in that business. That is allocable to you. So if you're a 50% partner, it's 50% of the 50% of the wages. So should you convert your employees to independent contractors? Absolutely not, because you just lost that 20% deduction, right? So even if you pass the employment test. Let's say you're real estate people. Well, real estate people don't have wages. They have property managers who take care of their properties. So for them, or not necessarily for them, but for anybody, there is another test. You take a look at 2.5% of your depreciable property, so lands out, as long as this property is still under the depreciation. So if you have a 40-year-old building, you don't get this deduction. And that's another thing is it's all depreciable property unless it's fully depreciated, or it's a depreciable property that has a life that is 10 years or longer. So for example, you get your bonus depreciation. Technically, it's fully depreciated, but you can take it for 10 years. So you take that, you take that 2.5% and you compare it to your 20% deduction. You think you're done? No. Then you combine all these things together. Once you figure it out one by one, you combine all that thing. And you look at your limitation on your taxable income, and then you look if there is enough of that deduction to cover 20% of taxable income. If it's higher, then you're limited to 20% of taxable income. Another issue with this deduction is, let's say you have a company A with $50,000 loss, and company B with $30,000 of taxable income. When you put them together, it's net loss. You don't get a deduction, because you cannot, there is an overall limitation. In addition, let's say next year, the company A made $100,000 in income, and company B, let's say, broke zero. It netted to zero. So you're thinking, okay, I'm getting $20,000, right? Because 20% of $100,000. No, you don't. Because to the extent that you had loss in prior year, that loss offsets your qualified business income from that entity in the following year. So you could see the amount of Excel spreadsheets that we will have to create to make sure that we track all this stuff. Now imagine. Yes.
Is this good for accountants?
Yes. Absolutely.
Remember what I said about simplification, right?
Yeah, this is a part of simplification. So yeah, imagine I have clients who have not hundreds, 100 K1s. I need to do this on a K1 by K1 basis. Yes, Ben?
For all those in real estate or development, when you are telling me the skills are not deductible, you mean the architect, the engineer, the designer, the mechanical engineer, the electrical, all of these are out?
No, you can deduct payments paid to them. They cannot take the 20% deduction. No, but architects can. The question was if you're a real estate developer and you're making payments to architects, designers, consultants, their income, you can deduct it, you can make, but they cannot.
20%. The 20% is going to affect the 20% or not?
They cannot take the deduction except for engineers or
What about us?
you get your 20% on taxable income. Yeah, you get it.
Doesn't matter
You,
what you pay to them.
well, but it's 20% of net income,
Net income.
right? So it doesn't matter who you pay it to.
They're not coming to item-wise that this item, this item,
Yeah,
this item,
exactly.
this item,
Yeah,
not-
exactly, yes. Speaking of limitations.
You know, you have one more question over here?
Yes.
You have the entity that has a savings account, and they're investing in treasuries,
Uh-huh,
and now it's a flow-through on the K1.
uh-huh.
Is that, if you qualify,
No, it has to be a business. And,
well, if the business has revenue and it has interest income?
oh, it's just part of the operating business.
Portfolio.
Portfolio is not subject to this. It has to be an active business.
Okay, but if the active business has treasury investment,
As part of, it's the cash that they're using. Yes, absolutely. Yeah, business interest qualifies. Yes, ma'am.
When you gave the figures of 315 or 415, is that per entity or?
No, this is taxable income on joint filing, on the individual return.
So if it's over 415,
You're subject to all of these limitations. Yeah. So that's a very simple new rule, qualified business interest. Next big thing that you guys need to know about, because especially you guys that are real estate developers, you know how everybody in here knows what passive losses are, right? So you invest in certain projects, whether it's active business or real estate or anything, and you cannot deduct passive losses in the year that you've generated them unless you have passive income to offset it with, right? You cannot generate net passive loss. That is not the case for active businesses. So let's say it's a company, again, let's make it a widget manufacturer, or it could be anything. There is a net loss from this company. You take the entire loss on your individual tax return, and it offsets everything on your tax return. That's no longer the case. And that loss,
Can you repeat again what you said?
you cannot, there is a limitation on how much active losses from active businesses you can take on your individual tax return. And that limitation is $500,000. So you can offset all of the income, active income, on your return, plus $500,000. So imagine a situation like this. You have a client, they have $1 million in interest and dividends. They've done well. They have active company A that generates $5 million of net income, and you have an active company B that generates $6 million of active loss. In 2017, when we prepared the return for this client today, it's $1 million of interest and dividends, plus 5 active, minus 6 active. taxable income is 0, right? That's no longer the case. Starting 2018, it's $1 million interest and dividends plus $5 million of active income minus $5 million of active income and minus additional $500,000 of active losses, what's called excess loss deduction. So you have this carryover of additional 500,000, which becomes NOL in the following year. But then this year, you're going to pay tax. So you're not losing this deduction, but your tax liability is accelerated.
By the way, that's the last slide, excuse me, in the individual section.
Yes, thank you. I'm not
And
I
that
gave-
$500,000 limitation applies to married filing jointly?
jointly, yes.
If you're anything else than married filing jointly, the limitation is $250,000.
So yes, that's huge, because all of a sudden, people with a lot of portfolio income, with significant losses from active businesses, they were able to offset it. That's no longer the case. Which, yes,
And that includes real estate.
it includes all active income,
Okay.
real estate and everything else.
Well,
Yes.
and here's the thing that we still don't know. Again, like Mark said, we still don't have regulations, so we still don't know the definition. But Una mentioned that this 500,000 loss can offset interest dividends, but it may also include wages. So if your client has $1 million of wages, and they have, they generally get a K-1 that generates, let's say, $2 million of losses, now they can only offset $500,000 if they're married of their wages.
Well, yeah, it's just, you can go negative by $500,000 only. So whatever's left on your tax return is taxable at that point. Which brings me to another big item, NOLs. Net operating losses going forward are limited to 80% utilization in any given year. Somebody pointed out to me today another thing that I didn't know or I didn't focus on. It's kind of interesting. I spent last month reading about this law and spending all these hours trying to understand it. Every time I open the section that I think I understand, I find another thing in there that's like, oh, I didn't think about that. So today, just before I came here, somebody pointed out to me that that 80% limitation on utilization of net operating losses only applies to losses generated in 2018 and after December 2017. So all the net operating losses that you guys accumulated prior to 2017, you can still utilize them 100% going forward. What do I mean by 80% limitation? Let's say you've got $100,000 of income, you have $1 million of net operating loss. In 2017, you deduct, you can take entire $100,000 of that net operating loss and offset your $100,000 of income. You pay no tax. Starting in 2018, you can only offset 80% of your current year income. So you're going to pay tax on the 20. Again, that's for losses generated in years after December 2017. So all the losses that generated prior to that, you can still take 100% on. Now we're going to have to track which loss generated in which year. And which loss it was utilized 100%, and which loss was utilized 80%. So that's another big thing. And a last big thing I wanted to talk about is the limitation on interest deduction. And limitation on interest deduction, unfortunately, is 30% of the net income before depreciation, amortization, real estate taxes, or actually taxes, and obviously interest. Small tax, it's a entity by entity limitation. So if the entity has less than $25 million of gross receipts, that limitation doesn't apply to you. However, those of you who do syndicated deals, it applies to you. because syndicates are not subject to that $25 million exclusion. So real estate syndicators, unfortunately, you'd be subject to that 30% limitation. And with that, my 20 minutes have expired. I will pass the baton to Sergio.
Thank you. Thank you, Una. There was a slide that I wanted to cover. It's actually in Una's section, but it's very pertinent to the real estate industry. Aside from acquiring the actual real estate, any type of business, any operating business that has, equipment, any type of personal property that's usually depreciated, 5 years, 7 years, 15 years. In the past, you might remember, actually up to 2017, you can take a 50% deduction on those assets. The requirements were this year, for 2017, is the assets had to be new, first time use. So you had to actually go to the manufacturer or the vendor and buy the assets that are new and start using them, and you can take this 50% bonus depreciation. Well, that's changed. From years, actually, for any assets acquired and placed in service after September 27, 2017, you can now take 100% bonus depreciation on those assets. And then they no longer have to be new assets, they just have to be new to you. So if you buy some equipment that another company used to use and they're no longer, maybe they went out of business and you're buying it from them, you can now take 100% depreciation. But what about for the real estate folk here? I'm a real estate, that's my expertise and that's what I focus on. And for those of you that buy real estate or have purchased real estate, you might have heard of something called the cost segregation study. And that basically, if you're buying, let's say, an apartment complex, you buy it, let's say, for $12 million to make it easy. You buy it for $12 million, and out of that $2 million is land and $10 million is building, right? So if it's apartments, you usually get to depreciate it over 27 and a half years. And then this thing came along called the cost segregation study, and it's what that does is, usually you hire an engineering firm, and they go and they break down the building and say, okay, there's a lot of these fixtures that are not part of the structural component of the building, so they're, you could depreciate them over 5 years. So they break down the assets between 5 years, 7 years, 15 years, et cetera. And before, unless you were buying a brand new building or you were constructing a brand new building, you couldn't take advantage of this bonus depreciation. Well, starting, like I mentioned, for any assets acquired after September 27th of 17, if you bought a property and you did a cost segregation study, those assets, those personal assets, 5-year assets, 7-year assets, you can write them off, in year one. And when I was talking to Harvey about this, we actually have one of our clients, or actually we happened to acquire a property, and we just happened to close escrow on September 29th. And it was a $90 million property. And so, we were going to do cost seg anyway. We do it for the tax benefits. But now we're going to be able to write off 100% of those, 5-year, 7-year, and some of those 15-year assets. The 100% depreciation applies from after September 27, 17 through the end of 2022. And then it goes down by 20% in so it's 80% expensing in 2023, 60% the following year, and et cetera. It goes down by 20% every year, and it goes away after 2026. So no more bonus depreciation after 2027. That just means you have to depreciate your assets over, again, 5 years, 7 years, et cetera. So let me get to my section. So when we're talking about real estate, there's this 20% deduction, right? I mean, I know a lot of you have heard about it, and I've had a lot of questions. And as both Una and Mark have mentioned, it's not a simple. I can't just. A client sometimes calls me and they want me to give them a quick answer on, hey, do I qualify for this? And it's not a simple answer, because there's a lot of limitations, a lot of factors I got to take into consideration, and especially for those of you who have multiple K1s, right? I mean, you may be able to benefit from get be able to qualify for the deduction on one K1, but then it's offset by the other. So at the end of the day, you may not get the benefit. So it's really not a simple yes/no answer. As you mentioned, there's you have to have qualified business income. Investment income doesn't qualify. Capital gains don't qualify. So it's really operating income and of course real estate income. And the real estate income, it was something that was added the last minute. Yes, do you have a question?
I had a question. If you house real estate in let's say, a wholly owned LLC, does that qualify as a pass-through entity?
Yeah, so for purposes of this, so the question was whether if you own real estate through a single member LLC, a wholly owned LLC, does that qualify for this 20% deduction? And for purposes of this deduction, qualified business income, from pass-through entities, they define pass-through entities as partnerships, as corporations, LLCs, and single-member LLCs, or even if you just own it directly, even if you don't have an LLC and you report that income on either on your Schedule C because it's an operating business or on Schedule E because it's a rental property. Yes?
Original.
So yes, so the question is, one of the limitations, as Una mentioned, on being able to take this 20% deduction, again, for my real estate clients, even if they do have some wages, it's very minimal compared to the amount of income that a rental property can generate. And so there's other limitation, which is 2.5% of which is actually the original cost basis. As long as the property is being depreciated, you can take you can qualify for the deduction. It's the lower of, and I have an example, and I'm not sure exactly where it is on the slide. Do you want to move forward? Oh, I have it.
I'll move it.
Oh, is it up there now? Okay, perfect. So here's an example I just want to cover, which talks to this point. It says, an LLC holds an apartment building that has depreciable assets of $50 million. So not including land, it's just the building and other assets it has. Again, it's all depreciable property, so if you have improvements, et cetera, that all counts. And it pays no wages and generates $2 million of rental income. So $400,000, which is 20% of the $2 million, may be eligible for the deduction. Again, there's other factors you got to take into consideration, but at least this one particular investment may qualify for $400,000. However, for this taxpayer, they may deduct the lower of the $400,000, which is 20% of $2 million, or 2.5% of $50 million, which is $1,250,000. So they qualify for the $400,000, at least for this particular investment. Yeah. Yes.
About being placed into service after September 27th. If you bought something before September 27th of 17, renovated it, or were working on it or whatever, and then let's just say a tenant moved in after that date, does that mean it is effectively placed into service after September 27th of 17?
Are you talking about the bonus depreciation?
Yes. That was
So
January 1 of 17.
yeah. So the question is, so again, the September 27th date is a hard date, right? I mean, any assets, and I have actually, unfortunately, I can't see the slide, so I don't know where it is. But if you guys go to page 15, it's on slide 29. It shows a chart that shows the amount of bonus depreciation you could take. Now, if it's an asset that you had acquired prior to 2017, but placed in service after September 2017, then you only get the 50% bonus. You don't get the 100% bonus. Now, to answer your question, David, I don't know the answer because there hasn't been enough guidance. Because that is a good question. I mean, what if you did buy property and there's a lot of work to be done to it, right? I mean, you can't place it in service, but let's say 3-4 months down the line, it's let's say 2018 already, and you place it in service. Does that qualify? Perhaps. I don't know.
Mm-hmm.
So they'll define that term.
Yes.
Other places in the code it is defined, but they haven't referred to those places.
Yes.
You have a property you acquired in a 1031. What do you use for the cost of the property for the 2.5
for the 2.5% calculation. So it doesn't matter how you acquired the asset. What matters is the asset still being depreciated. So if
Use original.
original cost, yes. Yeah. Plus, Lynn, if you exchange into a bigger property, obviously you're gonna have the step up. Yes.
Well, you're looking at your carryover basis in the 1031, assuming it's one, there is no increase in basis. So you've got, you may have acquired a $50 million property, but you exchanged something that you bought for 10. You're still looking at the 10.
Right.
Because that's your carryover basis.
Oh, that was my question. So, okay, so it's not the original cost, it's whatever your carryover.
Now, so let's say you're in 19,
The original property that's coming in, yeah, okay.
Right.
Got it.
Yeah. Let me see if I. Okay, are we all clear on that 20% deduction?
Yes.
Again, I'm not going to mess with the slides because I don't know where we are, but the next thing I was going to talk about is the interest expense limitation that Una was talking about. Now, again, it doesn't apply if your business doesn't generate gross receipts greater than $25 million. So for a lot of my clients that own real estate and they generate $5-10 million of gross receipts, this 30% interest limitation doesn't apply. But if you happen to be my wife, she also works for the firm, and one of her clients operates a hotel, and their gross receipts are obviously over $25 million per year, and so she was talking about this limitation, and if you thought the 20% limitation calculation was confusing, wait till either one of us or whoever your accountant is talks to you about the 30% limitation, which is 10 times more confusing. But she and I were discussing it, and what I told her was, as a matter of fact, I don't know if hotels qualify, but real estate businesses, they can make an election to be exempt from this 30% interest limitation. So, and how does that? I mean, I'm like, wow, what a great benefit, right? I mean, there's a small thing that changes. So usually, if you own a multi-family, an apartment complex, and you make this election to be exempt from this interest expense limitation, instead of depreciating the asset over 27.5 years, you have to depreciate it over 30 years. You just have to use an alternative depreciation method. If you own a non-residential, office building or retail or something, and you're depreciating it over 39 years, and you make this election to be exempt of this interest limitation, then you depreciate it over 40 years. So it's not. I don't think it's really a bad trade-off. But again, you would have to go through the calculations to determine what would be best for. We would have to actually go through the calculations to see what would be best for our clients.
Well, one caveat to that, the depreciation that special depreciation system that Sergio is referring to, called alternative depreciation system, and there is no bonus depreciation under the alternative depreciation system. So it's not just extending the life of the real estate. Maybe you're losing bonus as well. So you really have to model. It's like what's worth more, a bonus depreciation or limiting the interest expense? That's a carryover.
Although reading a little bit further into that law. And I went to a seminar that talked about this. They specifically mentioned this, and the law specifically, when you're talking about when a real estate individual or someone who owns real estate makes this election, the assets that have to be depreciated using this other method that I talked about, over 30 years and 40 years, applies only to real estate and qualified improvement property. They don't mention anything about personal property, so your bonus depreciation may still qualify, but again. It's still not 100% clear. Yeah. Harvey?
Since so much of these calculations are done at an individual level, not at an entity level, how will my K1 look different in 18 compared to 17?
It's going to be about 5 pages longer with all the disclosures.
Yeah, because remember, all these calculations are made, once you get your K1s, as a taxpayer, you have to determine, can I take this 20% deduction or not, or how much of this interest limitation applies to me. And again, if you have 2, 3, 4, 5, 10, 15, 100 K1s, you have to do it one by one. And these K1s, for you to be able to make that determination, they have to disclose certain information to you, or for your CPA to be able to calculate it. So as Una mentioned, there's going to be a lot more disclosures that are going to be attached to your K1s. So simple.
Yes.
Oh, good.
The 25 million is entity by entity or aggregate?
Entity by entity.
Entity by entity.
Yeah.
Entity by
You
entity.
can circumvent it by splitting this up.
However, if you're single employer after that, under that 400 whatever section that is, that qualify, the single
414, I think.
414 or something, it's aggregate. So go figure that one out.
Okay.
Harvey.
Yes, Harvey.
I think you also mentioned that professionals are out, whether it be doctors, attorneys, or accountants.
If their income is taxable income is over 315,000, correct.
But we also talked about the fact that doctors might have a side business. Maybe they sell prescriptions. Maybe they sell back braces. Maybe they do other things. Will I still qualify for that 20% for non-professional services?
Yes, and as Una mentioned, I mean, this 20% limitation or deduction is made on an entity by entity basis. So you may not, let's say you're a doctor, and your medical practice, you get a K1. You may not, let's say your income is $2 million. You may not be qualified to get that deduction on that specific K1, but if you have other businesses or you own real estate, et cetera, you could still qualify for the deduction for all the other K1s. Again, this is made on an entity by entity basis, the determination.
So what we don't know is whether you would have to carve out that side business from a professional corporation to have a separate LLC to sell the drugs on the side, or if
You mean prescription medicine?
You usually do.
or if keeping track in your entity specifically what portion of the business is related to that, and then disclosure would have to be in the tax return, separate activities. But we don't know yet. We don't have guidance.
Yes.
On this chart on page 15, if you build a brand new building, $50 million, suppose the cost of the construction, how can you depreciate the capital improvement? That capital improvement is the same as a machinery or as outside things, how it works?
Well, I mean, if it's a brand new building, I mean, I guess you would do a cost.
Well, you need to cost segregate it.
Right.
And, to the extent that it's structures, like the load-bearing walls and, the foundation, the things that make the building.
The bones.
The bones of the building. That's yeah.
It's a capital improvement, so what is the difference if the meaning of this law is the capital improvement, so building the building is capital improvement too?
No. Let's say, well, is elevator and escalator, is that a capital improvement?
Yeah.
Yeah? Yeah, well, there are certain specific things that are still depreciated over 39 or 27 years, and there are very specific things that you can take 5, 7, and 15 years depreciation or bonus. That's why we need cost segregation study.
We had this one, so what you're telling me, nothing has been changed. Always we have the cost segregation. So what is the difference between this new law that is telling that there is 100% depreciation on the capital improvement for a real estate developer that builds a brand new building?
Because in 2017, you released your building, you built the leasehold improvements, it's 50% depreciation. Now it's 100.
So you double it.
You double it.
Yes, you can take a full write-off of those.
Year
Year
one,
one.
yeah.
Yes.
Not over,
Yeah.
not 50%,
Yeah.
and then 5, 7.
Percent, yeah.
Yes, I heard one over here.
So on the lease improvement cost segregation, like before we did, that's subject to the 100% deductions and immediate bonus as well, correct? When you're depreciating the 15 years?
So you're talking about so we're talking about qualified leasehold improvement.
Yeah.
Yes, So that's one of the other things, that qualified leasehold improvements are now gone. That that definition no longer exists. Qualified retail property no longer exists. Qualified restaurant property no longer exists. They created something new called qualified improvement property, which generally includes qualified leasehold improvements. But to answer your question is, yeah, that qualifies for bonus depreciation. And it also qualifies for Section 179 deduction, which I'm going to talk about next. I know we're running out of time, so I just want to cover it really quickly. Actually, you know what? There's other important sections. 179 is you can take additional. Actually, no, it's an important one. I want to cover it. So Section 179, it's almost like bonus depreciation, where you can take 100%, you can 100% expense an asset in the year you acquire it. It's different than bonus in the sense that you have to have taxable income. It's limited by your taxable income. So if you have a business and you acquire a lot of assets, but it operates at a loss, you cannot take 179. There's a limitation. But if your business has taxable income, then you can take this deduction. In 179, now you can take up to $1 million starting in 2018. In 2017, it was 510,000. The thing is, certain improvements can now be fully. You can take 179 on. For instance, if you own, this is only for non-residential property, and if you go in and you own a retail center and you've owned it for a few years and you're like, I gotta change the roof, it's leaking all over the place, and I gotta change the HVAC, etc. Those assets previously you had to capitalize and depreciate over 39 years. Roofs and HVAC. Now you can take, you can fully write it off up to $1 million. And that includes roofs, heating, also your HVAC, fire protection and alarm systems, security systems. And you can also now take 179 deduction on residential real estate. Yes?
But you can't carry forward those losses if you don't have any support.
What do you mean? The 179, so if you elect to take 179 in the current year and you cannot use it for whatever, let's say you have a loss, yes, you do carry it forward. Mm-hmm. Yes?
One point on 179, if you look at the way what 179 is, it's a qualified business expensing, meaning it's no longer a depreciable property. Guess what happens to your 20% limitation when you do that, when you elect 179, right? It's no longer a depreciable property. So it's no longer an easy decision. Hey, can I expense it? Am I going to expense it or not? Well, maybe by expensing it, you're better off leaving it on the books and depreciating it and getting a 20% QBI deduction. So just a little point. So it's a full employment act for us. I'm not kidding.
Another important section, 1031 exchanges. For my real estate clients, I think you guys were very excited to hear that's the only asset that real property that you can now exchange. Personal property can no longer be exchanged. So real property qualifies. And it's real estate that is not held primarily for sale. So if you're buying, improving, and selling, if you're flipping property, that doesn't qualify for 1031 exchanges. Let's see. Oh, and then the last point I wanted to cover is carried interest. I don't know how many of you kind of encounter this, whether you get a promote or a carried interest. Previously, if you, let's say you're a promoter and you start up a deal and you generate income, and within a couple of years, there's a big gain. You could have participated in that gain and you get a long-term capital gain rate. Well, that's no longer the case. If you don't hold the investment for at least 3 years, that gain is no longer a long-term capital gain. It's a short-term capital gain, which means you're now paying tax at ordinary rates. Does anybody have any questions in regards? Oh, yes.
There was a slide in the business section on business meals and entertainment expenses.
Yes.
Like they're gone?
No, entertainment is gone. So when
Luxury box.
when you take your clients to see Lakers, non-deductible. When you take your business associate to, I don't know, any restaurant, still 50%. On that vein, what I wanted to mention for the attorneys in the room, you know, you work in nice buildings, right, just like we do, and you have 200-300 associates in your company, and you pay about what, $400 for parking, right, per month. Well, guess what? Non-deductible, or you need to include it on their W-2s. So that's for big law firms and big accounting firms, big architectural firms. It's a big deal because it's thousands of dollars.
Didn't know that.
Yeah.
Take the bus.
That's also non-deductible.
Any other questions?
Yes.
Just to understand, you mentioned the 315,000 and 414,000.
Uh-huh.
I'm trying to understand, so if you earn 315 or 415, $100,000 more, what is your net going to be? You're going to be paying a lot.
No, this is taxable income.
After all the deductions.
After all the deductions.
Everything.
It's taxable income. So, you know, if you're a $500,000 taxable income, get a defined benefit plan to get you to 315, right? So you can get the 20%.
Like to thank you. Oh, one more.
Oh, yes.
Somebody asked a question about 45 minutes ago, and I still don't understand the answer. And that question was, if you have a business, that business generates liquidity, takes that liquidity, and invests in liquidity. The example that gentleman used was treasury. Whatever example you think of, you still have a bunch of liquidity cycling inside the business. And you've invested it for purposes of just simply holding liquidity. How is that, how is the income generated from that liquidity treated for purposes of all of these tests?
I'm gonna guess here because we have no regs, and the reason why I'm gonna guess is because qualified business income, the way it's defined in the law, is not perfectly clear. So it's referring to the old code section that had to do with domestic production activities. So that's why I'm thinking it's active production income. I mean, if you have a little bit of interest in dividends that you're getting from your regular accounts, that would qualify for sure. If you have millions of dollars sitting at Morgan Stanley, for example, generating a lot of interest in dividends, and it's just sitting there doing nothing, I'm thinking that does not qualify. But, that's my interpretation of the law. I will wait for the regulations. Yes?
I agree with you. I think it's like looking at K1, ordinary income, you get interest and dividends. My guess is we're looking at the ordinary income.
Well, but also business interest.
Right.
So there would be, I would imagine they would be a separate line. Business interest, non-business interest. So non-business interest, probably not.
All right. Thank you again for coming. We invite you to contact us if you have any questions. Thank you again. All right. Not bad.
I think portfolio comes out. Working capital, money invested for working capital, that's hard to find. But that's